You have seen the numbers. You have watched our investigations into the exit tax and the death tax. You now know that the Canada Revenue Agency is waiting at the finish line of your life, ready to confiscate a massive portion of your home equity through aggressive audits and the devastating new 66% capital gains inclusion rate. You have realized that selling your property triggers a massive tax bill, and dying with your property triggers an even bigger one. But you sit at your kitchen table, looking at your adult children, and you devise a plan. You decide to outsmart the system. You are going to transfer your secondary property, your cottage, or perhaps even your family home to your kids right now, while you are still alive, and you are going to do it for $1 single. Or maybe you will just gift it to them entirely for free. You sign the deed, you pay a small legal fee to a real estate lawyer to register the transfer, and you sleep soundly. You believe you have successfully bypassed the Canada Revenue Agency. You believe you have secured your family's generational wealth and beaten the government at its own game. You have not beaten the system. You have just walked blindly into the most financially catastrophic trap in the entire Canadian tax code. You have triggered what accountants and tax lawyers whisper about behind closed doors. The double taxation trap. Welcome back to Canada Property Watch, where we decode the financial matrix that is systematically draining the wealth of the Canadian middle class. We have exposed how the government targets your equity when you sell, and how they target your estate when you pass away. But today, we are exposing the ultimate penalty for trying to be generous. We are breaking down the $1 mistake and revealing why transferring real estate to your family members below market value is not a legal loophole, but a guaranteed trigger for a devastating CRA audit that will tax your family twice on the exact same money. By the end of this investigation, you will understand why the government's tax algorithm is specifically designed to punish parents who try to give their children a head start in a broken housing market. To understand why this trap is so lethal, we have to look at the foundational rules of the Canadian Income Tax Act. Specifically, the rules governing what the CRA calls non-arm's-length transactions. In the eyes of the government, an arm's-length transaction is a deal between two strangers on the open market. The buyer wants the lowest price, the seller wants the highest price, and the resulting sale price is considered the true fair market value. But when you deal with a blood relative, a child, a sibling, a spouse, the CRA automatically classifies this as a non-arm's-length transaction. The government assumes, by default, that you are colluding to manipulate the price and avoid taxes. Therefore, the CRA completely ignores whatever price you wrote down on the contract. They do not care if you sold the house to your daughter for $1, $100, or a polite handshake. The CRA legally replaces your fictional sale price with their assessment of the property's absolute highest fair market value on the day the title was transferred. Well, let us walk through the brutal mathematics of the $1 mistake, because this is where families are being entirely wiped out. Imagine you bought a rental property or a modest cottage 20 years ago for $200,000. Today, because of the massive inflation in the Canadian housing market, that property is worth $1.2 million. You want your son to have it, you sell it to him for $1. You file your taxes the next year and report a sale price of $1, claiming you made no profit and therefore owe no capital gains tax. The CRA's automated system, which is directly linked to the provincial land registry, flags the transaction instantly. They see a property worth over $1 million transferred to a relative for a single loonie. The audit letter is automatically generated and mailed to your home. The CRA auditor informs you that under the deemed disposition rules for non-arm's-length transfers, you are deemed to have sold the property for its full market value of $1.2 million. You are now legally required to pay capital gains tax on a $1 million profit, a profit you never actually received. Because of the new federal budget, any capital gain over $250,000 is hit with a 66.7% inclusion rate. You, the parent, are suddenly handed a tax bill of roughly $350,000, payable immediately with compounding daily interest. And remember, you did not get any money from your son to pay this bill because you only charged him $1. You are now forced to empty your retirement savings or take out a high-interest mortgage on your own primary residence just to pay the tax on a phantom profit. But that is only the first half of the nightmare. That is the single taxation. The true horror of the $1 mistake is what happens to your son years later. This is the double taxation trap. Let us fast forward 10 years. Your son has enjoyed the property, but now he has a growing family and needs to sell it to buy a larger home closer to his work. He puts the property on the open market and sells it to a stranger for $1.5 million. When his accountant sits down to calculate his capital gains tax, they have to determine his adjusted cost base, which means, what did it cost him to acquire the property? In a fair system, because the CRA already taxed the father as if the house was sold for $1.2 million, the son's cost base should logically be $1.2 million. But the Canadian tax code is not designed to be fair. It is designed to extract maximum revenue. Under the strict reading of the law, because the son only paid $1 for the property, and his legal adjusted cost base is exactly $1. The CRA does not adjust his cost base upward to match the phantom price they forced the father to pay taxes on. Therefore, when the son sells the property for $1.5 million, his taxable capital gain is $1,499,999. He is taxed on the entire growth of the property from the very beginning. The exact same $1 million of equity that the father was taxed on 10 years ago is now being taxed a second time in the hands of the son, and again at the punishing 66% inclusion rate. The father paid $350,000 in tax. The son now pays over $500,000 in tax. The family has collectively paid nearly $900,000 in taxes to the federal government on a property they originally bought for $200,000. The generational wealth has been completely incinerated. It was not lost in a market crash. It was not lost to a bad investment. It was legally confiscated by the state because a parent tried to do a favor for their child without understanding the draconian mechanics of the Income Tax Act. But you might be listening to this and thinking, okay, I won't sell it for $1, I will just legally gift it to them. A gift has no sale price, so there can be no tax. This is the second great myth of Canadian real estate planning. The exact same deemed disposition rules apply to a pure gift. The moment you change the name on the title from yourself to your child, the CRA deems you to have sold it at fair market value. You trigger the massive capital gains tax bill for yourself today. The only slight mercy of a pure gift, documented formally with a legal deed of gift, is that the child's cost base is generally bumped up to the fair market value at the time of the gift, which avoids the double taxation scenario. But it still forces you, the parent, to pay hundreds of thousands of dollars in taxes out of pocket right now for an asset you gave away for free. If you do not have the liquid cash to pay that tax bill, the CRA will place a lien on your other assets and will freeze your bank accounts and ruthlessly pursue you into bankruptcy. The trap mutates into an even more dangerous form when we talk about adding a child to the title of a property as a joint tenant. We touched on this in our previous investigation, but we must dive deeper because this is the single most common mistake middle-class Canadians are making right now in 2026. Parents see the astronomical prices of real estate and realize their kids will never qualify for a mortgage on their own. Or the parents are getting older and they want to avoid the provincial probate fees we discussed in the death tax video. So the parents go to a lawyer and add the adult child's name to the deed of the primary family home for $1 or for natural love and affection. The parents still live in the house. The child lives somewhere else, perhaps renting an apartment in the city. The family thinks they have created a seamless succession plan. The CRA sees a massive taxable event. But by adding your child to the title as a 50% owner, you have legally disposed of half of your property. If the house is your principal residence, you can use your principal residence exemption to shelter that 50% disposition from taxes today. But you have just planted a ticking time bomb for the future. Fast forward 15 years. The parents decide to downsize and sell the family home. The home has increased in value by $800,000 since the child was added to the title. The parents claim their principal residence exemption on their half of the sale. It is tax-free. But what about the child's half? The child has not been living in that house. They have been living in their own apartment. Therefore, the child cannot claim the principal residence exemption on their 50% share of the parent's home. The child is suddenly hit with a capital gains tax bill on $400,000 of profit. They have to pay a massive tax on the sale of a house they never even lived in, all because their parents were trying to help them. And the tax liability is the absolute best case scenario of adding a child to your title. The worst case scenario is the total loss of the family home through legal liability. When you add your child to the deed, they become a legal owner of the asset. Their financial problems instantly become your financial problems. If your child starts a business that fails and they are forced to declare bankruptcy, the bankruptcy trustee will look at the land registry, see that your child owns 50% of a paid-off house, and the trustee will force the sale of your home to pay your child's creditors. If your child gets into a severe car accident and is sued for millions of dollars beyond their insurance limits, the plaintiff's lawyers will place a lien on your home. If your child gets married and subsequently goes through a bitter divorce, their ex-spouse's lawyer can legally demand half of the child's share of your house as part of the family asset division. You could find yourself forced to take out a mortgage in your 70s just to pay off your child's ex-spouse, simply to avoid being evicted from the home you spent 40 years paying for. Though you risked everything to save a 1.5% probate fee. The Canada Revenue Agency knows exactly how common these amateur estate planning mistakes are, and they have built an automated surveillance machine to catch them. The days of flying under the radar are over. Every single time a property title changes hands at the Provincial Land Registry Office, a digital record is generated. This record includes the names of the parties, the relationship between them if stated, and the consideration paid. This database is cross-referenced with the CRA's mainframe. The algorithm scans for transactions where the transfer tax paid or the declared sale price is drastically lower than the municipal property assessment or the automated valuation model for that neighborhood. If the algorithm spots a $1 million house changing hands for $1 or $50,000, it does not require a human auditor to flag it. The system automatically issues a demand for information. They will ask you to prove that the transaction was at arm's length. They will demand to see the appraisal you used to determine the sale price. If you cannot produce a certified, independent appraisal proving that the house was actually a teardown worth nothing, the auditor will impose their own valuation, and the CRA's valuations are notoriously aggressive. And they will look at the highest comparable sales in your postal code at the peak of the market and apply that value to your property. The burden of proof is entirely on you to fight them in tax court, a process that takes years and costs tens of thousands of dollars in legal and accounting fees. Furthermore, the CRA looks at behavioral flags. If you transfer a rental property to your child for $1, but you continue to collect the rent checks from the tenants and deposit them into your own bank account, the CRA will strike down the entire transfer as a sham. They will hit you with gross negligence penalties. These penalties are not just a slap on the wrist. A gross negligence penalty is an additional fine equal to 50% of the tax you attempted to evade on top of the original tax bill, plus compounding interest from the date the tax was originally due. The government will financially break you for attempting to deceive them. So, how do the wealthy transfer real estate to their children without triggering the double taxation trap or the catastrophic deemed dispositions? They do not use $1 gimmicks. They use the rules of the system to their advantage. If a wealthy parent wants to transfer a property to a child, they sell it to the child at the exact documented fair market value. They hire an appraiser to establish the undeniable price, but the child does not have the money to buy it. So the parent acts as the bank. The parent takes back a mortgage on the property for the full purchase price. The child signs a legally binding promissory note to the parent. Now the title has been transferred cleanly at market value. There is no $1 mistake. The parent still has to report the capital gain. But because they have not received the cash yet, they only received a promissory note, they can use a mechanism in the tax code called the capital gains reserve. This allows the parent to spread the tax hit out over a period of up to 5 years, drastically lowering their marginal tax rate and avoiding the devastating 66% inclusion bracket in a single year. The parent can then choose to forgive a portion of the mortgage debt every year as a tax-free cash gift to the child, I'm slowly transferring the wealth without triggering the wrath of the CRA algorithm. Alternatively, as we discussed in the death tax investigation, the wealthy use formal trust structures. They do not put their children's names on the deed. They put the property into a family trust or an alter ego trust. The trust legally owns the property, shielding it from the child's future divorces, bankruptcies, or lawsuits. The trust dictates exactly how and when the wealth is distributed, and ensuring that the transition happens in the most tax-efficient manner possible, orchestrated by top-tier tax accountants who know exactly where the CRA's tripwires are hidden. The middle class does not do this because setting up a proper mortgage takeback or a formal family trust costs $5,000 to $10,000 in legal and accounting fees up front. The middle class balks at that price tag. They think it is a ripoff, so they go to a discount lawyer, pay $500 to transfer the deed for $1 single and unknowingly trigger a $500,000 tax liability that will destroy their family's financial future 10 years down the road. They trip over dollars to pick up pennies. The Canadian government is relying on this exact behavior. They know that the middle class is financially desperate, stressed by high interest rates, and terrified of the new capital gains taxes. They know that when people are scared, they make irrational, poorly advised decisions to protect their assets. The entire apparatus of the Canada Revenue Agency is waiting patiently for you to make that amateur move. The exit tax catches you if you sell to a stranger. The death tax catches you if you hold the property until the end. And the $1 mistake catches you if you try to pass it on early. Every exit door in the Canadian housing market is now heavily guarded by the state. And the toll to leave the building is a massive percentage of your life's work. You cannot navigate this environment with advice from internet forums, your neighbor, or your real estate agent. The laws have become weaponized. The inclusion rates have shifted. The surveillance algorithms are active. If you own property in Canada, you are no longer just a homeowner. You are the manager of a highly targeted financial portfolio, and you must act like one. You need a defensive perimeter. You need to consult with a chartered professional accountant and a specialized tax lawyer before you sign a single piece of paper that alters the title of your assets. We are living through a period of historic wealth extraction. The government has accumulated unprecedented levels of debt, and they have decided that the untaxed equity resting in the homes of the Canadian middle class is the solution to their balance sheet problems. They are using complexity, confusion, and the natural desire of parents to help their children as the mechanisms for this extraction. Subscribe to Canada Property Watch. We are reading the legislation, we are tracking the audit trends, and we are bringing you the unvarnished reality of the Canadian financial system. We are arming you with the knowledge you need to protect your family from the traps designed to dismantle your wealth. Do not let a well-intentioned gift become the financial ruin of your children. And do not make the $1 mistake. Stay vigilant, seek professional counsel, and guard your equity. We will see you in the next investigation.